Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. It's a Monday morning in October, and the government still isn't open.
That's been the theme all month, and it doesn't matter because the stock market's at record highs.
It certainly seems like investors are brushing it off. So let's get to the biggest stories right now. In the nearly $19 trillion global ETF industry, stocks, as we mentioned, rising to another record high. Optimism lifted even higher as President Trump and President Xi are set to unveil some trade agreements at a summit later this week.
Goldman Sachs launches a new fund that delivers private equity-like returns. In a moment, we'll speak to Brendan McCarthy. He is the firm's global head of ETF distribution.
And the future structure of QQQ remains in flux. The vote to convert the $400 billion fund to an open-ended ETF is delayed, a postponement with potentially large consequences for Invesco's revenue outlook. We'll discuss all of that and more. But as always, Eric Balchunas from Bloomberg Intelligence, he's finally back, and he's looking at the flows. Eric, what do we got?
Katie, Scarlett, I miss you guys. I really did. And you know what didn't change since I was gone is VU at the top. Shocker. VU, by the way, 99 billion. So it's a hair away from 100 billion, and it's clearly going to break its record. More on records in a minute. Qs with inflows, JMUB, that's JP Morgan, municipal bond. And this is also JP Morgan Europe. This is probably some kind of a model or private banking flows here. Some ag money, government. So mix of stocks and bonds. Let's look at the outflows. And you can see a big whopper outflow from SPY. SPY, that'd be the trading crowd money. So you have maybe the retail buying, trading crowd maybe taking some profits. This is a floating rate ETF. Interesting. If you think rates are going to go down, that makes sense, right? And then some money here out of bond ETFs and some leverage ETFs seeing some outflow. So mixed bag, but more on record. So interesting speaking, if you look at the year-to-date flows, launches, and volume, those are the three major categories we track for ETFs. And they're all going to break a record. And this is, I call it the triple crown. It's hard to get all three. Normally in a good year like this, where stocks are up, flows and launches are easy to record, but volume's tough. Volume typically spikes up only when the market's down. But this year, we're going to see flows at 1.3 trillion, so 16% over the record. Volume is going to be 53 trillion, 13% over the previous record, and launches 1,000, which is going to be 51% over the record. So beating the record by double digits in each category. This is one of those years that we've been talking about, Katie, where everything's coming together.
Absolutely wild. Eric, thank you. And joining our conversation now is Brendan McCarthy. He is global head of ETF distribution over at Goldman Sachs Asset Management. Brendan, great to see you in person.
Thanks, Katie. Great to be here.
I feel like we have to start with that table that Eric just walked us through because, okay, we know that launches have been hot. We know that flows have been very hot. To see volume, as Eric mentioned, really outperforming in an up year, not necessarily the environment where you would expect to see a lot of volume spikes. Would love to hear what you make of it and what's driving that. Yeah,
I mean, it really isn't a surprise to see those volumes and to hear Eric talk about the trading type of strategies that are really driving it, whether it be your beta exposures like S&P, some of the fixed income exposures, but also gold. I mean, the volumes we're seeing at gold are just incredible, and we're certainly seeing that in our lineup as well. But markets at all-time highs, whether it be hedging, whether it be adding to positions, I'm not surprised at all by these volumes.
So how does that set us up for 2026? I mean, there's a frenzy of activity going on right now, and people are expecting good things for 2026 because the administration is just getting started with deregulation, and it's a midterm election year as well. So there's this sense that the good vibes will continue.
Yeah, I mean, definitely sense the good vibes will continue. What we're talking to clients about, though, is how do we prepare for that? And we're seeing it in the flows right now, too. So we're still talking about diversification. We're still talking about what to do with, cash right now in the head of Fed, and so that's really setting up for next year as well. But really, diversification is really top of mind, and we're talking about going down to cap. We're looking at equal weight exposure. We're also talking about what is next when it comes to diversification, which is why we recently launched GTPE, our private equity tracking product. Yes.
I'm glad you brought this up because private credit, no offense, it's a little dull and like nobody cares. It seemed like private equity, especially the XOVR, which we talk about sometimes, put SpaceX, and all of a sudden the flows came in. You now have this private equity tracker with the Goldman name. I know it's going to get flows, but here's the question: help sell it to me. I feel like normally with ETFs, people want the real thing. They want actual private equity, not a synthetic version where you're trying to emulate the returns. How confident are you can do it and sell it?
Yeah, so great question. So let's talk maybe a little bit about why now. what is it and how it works? That will really address your question. In terms of, why now? Demand for private asset exposure, demand for alternatives, we're seeing that every day. And at Goldman Sachs Asset Management, we're working with our clients, across the spectrum, traditional, semi-liquids, but there's still a gap in terms of real access and greater access, right? When you think about private equity, it's, access to breakthrough themes. It's the ability to get exposure to small companies that haven't gone public, mature companies that maybe don't want to go public, right? So that exposure is in high demand for that type of diversification. In terms of what this product is, well, let me tell you this. Let me tell you what it's not. I'm going to surprise you by leading with that. It is not direct access to private equity. That's really important because we want to be very clear about what it is and what it isn't. It is an index. It is tracking the MSCI World Private Equity Return Tracker Index, right? That's a really important clarification because it's doing that it's doing that by replicating the characteristics of private equity through a portfolio of public equities. How is it able to do that? This is a data story, right? And the data is, what is MSCI able to access, right? They're able to access through their private asset database, working with thousands of LPs that they have access to, deal level information, fund performance information. You're talking about access to over $7 trillion of assets, 8,000 funds, almost 80,000 portfolio companies. What is that data providing us? Information around fees, cash flows, valuations. What can they then do with that data? Well, they can then translate it into characteristics you talk about all the time. Region, style, factor. Now we can replicate.
This reminds me of like Beyond Meat, where you're basically creating something that tastes like meat, but it's not the real thing. And again, we'll see if this works. Why not? Because you can put, I think, up to 15% of illiquid things into an ETF. Why not just cram SpaceX in there or something, given XOVR had success with it?
So I love that question, and I'm going to put it back this way. And I'm a strong believer, been around ETFs for too long to admit, that the ETF wrapper will continue to innovate. But just because we can put something in the ETF wrapper, should we? I do think we will get there. I really do believe that. But right now, when we sit across the table from our clients at Goldman Sachs, we can talk to them about true private equity. We have those funds. We have those mandates. We can talk to them about semi-liquids, right? This is now broadening the access to maybe those who face the challenges, whether it be high minimums, high fees, lockup periods. So we're taking accessibility to a different level.
Right. So Brendan, when you talk about accessibility, it sounds like you're trying to access particularly the retail investor subset. Is that accurate?
So mostly. I would say there's two broad use cases here. One is just as you described, just accessibility, whether that be for retail and beyond, but for those who really cannot get over those hurdles around high minimums, documentation, complex diligence, et cetera. It really is just that accessibility to get a flavor of private equity-like returns. Repeat, private equity-like returns. That's a really important clarification, and we do not want to hide from that. We want to be very clear on that. But the other use case, Katie, though, is thinking about what can I do with cash and equitization, right? Whether you're waiting for your allocation to be called in your private equity placement, whether you are waiting for capital calls, or simply you're a manager who's trying to manage a liquidity buffer. What are you doing with that now? Probably a variety of cash-like instruments. This may be something you can use there as well. So we do think there's both a wealth, a retail, as well as an institutional use case as well.
I'd like to hear a little bit more about Goldman's overall strategy with ETFs. I see that you have more than 30 active ETFs globally. You're launching this private equity-like return ETFs. Eric Balchunas compares the ETF industry to a terror dome, right? Because fees, bright, shiny new things. It's
out there.
It's hard to
it's
make
hell for issuers, heaven for investors.
There you go.
So why are you in the ETF universe? Goldman doesn't need to be in the ETF world.
Oh, we absolutely need to be in the ETF universe. You know why? Because when we sit across from our clients, we are a full-service asset manager. We're talking to our clients about everything from publics to privates, up and down. We want to serve the entirety of that portfolio. We are absolutely in the ETF game, and it's a growing importance to us, right? So when I think about our strategy, it is getting, and you guys report on this all the time, it is getting more active-like. We're entering the terror dome, Eric, right? So it is getting more active-like, but we're focusing on the strategies, the investors that our clients know, where we have followership. And you're right, this product, this is an index product. Isn't that interesting? With all the talk we do about active management, but when you think about where the industry is going, we love to define things. We love to put things in buckets: index, active, smart beta. It's all blending together to an extent. When I look at this product, it is rules-based. It is rules-based based on some really critical data that was not accessible before. You could argue that database, which is ever evolving, and our ability to replicate that, we're not going to back away. That is rules-based. In fact, we're going to embrace that because the data is so critical here.
All right, so it's not direct private equity and it's rules-based. Those are the takeaways here. Brendan, have to leave it there. Really appreciate you stopping by the studio on a Monday. That is Brendan McCarthy. He is global head of ETF distribution over at Goldman Sachs Asset Management. Now, coming up, the proxy vote on QQQ delayed. We'll discuss the benefits that come with possible ETF conversion next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with T. Rowe. You may know them as an index giant, but they had a really interesting filing last week, filing for the T. Rowe Price Active Crypto ETF. This would be their first crypto ETF. And not only that, it would be actively managed as well. So again, just filed last week. We'll keep an eye on this one when it does eventually launch rather. Let's talk about the big three, though. You know them well: BlackRock, State Street, and of course Vanguard. They basically control the industry when it comes to assets and when it comes to flows. But as Bloomberg Intelligence points out, their share of flows has been slipping right now at the lowest level year to date in years. So we'll have to see how this develops as we get closer to 2026. Certainly, we know a lot of upstarts, a lot of active ETFs have been taking some of that demand. Let's also talk about Invesco, though. The Qs. There had been the proxy vote on Friday to basically ask shareholders of the Qs to convert it from a unit investment trust into an open-ended ETF. Of course, this would be good news for Invesco because in its current setup, it doesn't really get any revenue from the Qs. But we learned on Friday that meeting, that vote, is being delayed until December 5th, Scarlett.
All right, so let's talk about this more with Neil Sipes of Bloomberg Intelligence, who covers the big asset management firms. Neil, the fact that it was delayed or that we didn't get a resolution, is that a good sign or a bad sign for Invesco's efforts?
Yeah, look, I think the delay is something that was always possible. Importantly for Invesco, and I think you saw this in the reaction of the stock on Friday, which had some pretty dramatic swings, is the catalyst is still out there, right? This is a pretty meaningful development for Invesco if it does go through. So I think that's still, in the near term. The expectation is December 5th, we'll have yet another meeting. The goal, of course, would be to reach that 51% threshold by that date. And I think, some of the commentary that we got from the release on Friday was encouraging, right? The votes were overwhelmingly positive. They mentioned they were approaching that 51% threshold. So we'll have to see, an extra month and a half buys them a little bit more time to continue to garner more yes votes and trend further closer to that 51%.
And just to meditate on the shares and what a catalyst this has been, Invesco, since July 17th, which is when they filed their initial proxy, up about 38% on a total return basis in that period. So clearly one of the best performing asset managers out there when you take a look at the stock market. But just to make sure I understand correctly, so the fact that the meeting has been adjourned to December 5th, it's not like the votes reset and they have to go out there and try to reach a 51% quorum in that time. It's sort of accumulates if in the coming weeks.
Right, and I think that's the idea, is depending on how close we are to 51%, gathering that incremental handful of percent is the goal today. And I think when you look at QQQ, a bit unique when you look at some of the largest funds out there is it's heavily retail owned in terms of a total percentage. So about 35% institutional owned, 65% retail. And I think that's why you've seen some of the challenges in garnering the support, is that's a very granular holder base. And so ultimately getting that support from a handful of thousands, if not millions of holders, is challenging. So our math shows about 1 in 4 retail investors, 1 in 4 retail shares, I should say, need to vote yes, and I think that's what they're working on.
Can you explain what this does to their profit? Because the Qs, I believe, is the most profitable or revenue-generating ETF, at least it's top 2 or 3. Is that why the stock is up 40% above, almost it's double BlackRock and the S&P? I'm assuming this is all going to come back to them as pure profit. There really is no overhead because they already have the overhead.
Right, and so I think that's why you've seen some multiple expansion in Invesco is, this is a very fast-growing ETF, about 10% organically on flows over the past 5 years. So it significantly increases the growth profile of Invesco. And as you noted, Eric, it's been the most revenue-generating ETF, but ultimately they haven't been seeing any of that. Right. And the 6 basis points needs to go back to marketing. So unlocking that, it's 3% of revenue, 10% of profit. So as we get to that 51%, that catalyst is still out there.
Very quickly, is there an argument for shareholders to vote against this conversion?
I don't really see any. I think it's been shown as a win-win for both Invesco and shareholders. Going to get a 2 basis point reduction in the expense ratio from 20 to 18. And ultimately, the dividend reinvestment, the tax efficiency that everyone loves about ETFs, that's also a benefit to the end shareholder, as well as the revenue and profit generation for Invesco. So win-win, and we'll have to check back in on December 5th.
All right, so the challenge lies in getting the word out then. Neil Sipes, thank you so much of Bloomberg Intelligence. Now, still ahead on ETF IQ, we speak to Liz Dillon of Pictet Asset Management's U.S. on the firm's first ETFs. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, you're back, so you get to do it.
All right. Yeah, I know you appreciate that.
Yes.
Let's look at today PBOT. So this is a Pictet AI and automation ETF. It's a baby. It just was born recently. And this is a company from Europe, and they are launching some thematic ETFs here. So this thing is brand new, 10 million, charges 70 bips. And you can see it just came out. Let's look at the holdings. You're going to see some stocks you recognize, some stocks you don't, right? So this is looking to capture this AI theme. You got some big ones and some smaller ones. Again, the stock picking is the key here. Let's look at the performance of this. It's only been a very short period of time, so you can't really take too much from this, but good start for this thing. I think BOTS is probably its biggest competitor, maybe ARKQ, and then obviously the S&P. And you can see here, it's beating all of these. And that's what it's going to have to do, Katie and Scarlett, if it's going to get some flows. That's the key thing for thematic ETFs.
All right, Eric, thank you. Joining us to talk about this ETF, I'm thrilled to say we have Liz Dillon. She is CEO of Pictet Asset Management USA. Great to have you with us on set, Liz. So Pictet has been around for over 200 years. And I ask this to every newcomer to the industry. Why launch now?
So we think it's the perfect time to launch, and we're launching because of demand from clients. It's a 220-year-old firm. I've been covering the U.S. market for the firm for over 20 years. We used to have a fly-in, fly-out model. We're new here in the U.S. with a local presence, 5 years running. And really, it's clients today, they want ETFs and they want our products, and I think it's the perfect marriage.
And it looks like you skipped the European ETF world as well. So you went straight from mutual funds in Europe to a U.S. ETF product. What's the thinking behind this, behind skipping that step?
So it could come later. Europe, obviously, that's our home turf. And we do have an international product, PQNT, which I think is really interesting. You were just talking about PBOT, which invests in AI. And we have PQuant, which uses AI to invest. And this is in the international space. As far as I know, there's nothing out there like that. Really innovative. That's 30 bips. And I think we're able to offer it at such a competitive price because the machine's doing a lot of the work, but they sit alongside, these PhDs. 80% of the investment team are PhDs. So I think that does lend to our European heritage.
And when I think of thematic ETFs, I think they have to have a shiny object moment. where they just go like that and people look at them. You have 51 stocks in here, so it's definitely prime to possibly pop. What else do you say when you're trying to sell this as you're waiting for the returns to hopefully come?
So we know a lot about themes. I'm not sure that the U.S. market's aware, but we are the actual OG of themes. We were the first one to launch it. When I joined the firm 24 years ago, I got my success with the firm by selling the water fund. That today is a $9 billion fund. But we know it takes time. So we want pop. Everyone wants pop. But we also, we're long-term. It's a $70 billion franchise. There's 70 people that work in our megatrend investing. And Peak Clean is one of the strategies that we're also promoting, which is a combination of single thematic strategies such as water, regen, global environmental, and clean energy.
Well, that's what I wanted to talk about. You have these two AI flavored funds, and then you have the Cleaner Planet ETF. We know that ESG has been in an interesting spot over the last couple of years. The term itself became really politicized, troubled,
toxic even.
We could use all these different phrases. I know you have this longer term focus and timeline that you're measuring success by, but talk about launching an ESG ETF in 2025, given that recent history.
Sure. So ESG is in our DNA, and we're not going to hide away from that. That's who we are. It's fundamental. We're a Swiss firm, so it would be kind of crazy if it wasn't. But I also see this as a tech play. So really looking for the companies that are innovating to protect us with what's happening in the environment. We don't need to see many more natural disasters to know that it's the companies that transform the world that are going to be profitable. And really our ultimate goal is always, ESG is good to do, but we're really in the business to make money for our clients.
You describe Pictet as the OG in themes. You also have strength in emerging markets.
Yes.
What's the appetite for EM exposure right now, and is that next in your ETF offerings?
That's exactly right. So those products should be launching. We have both an EM fixed income product that's coming to market and an equity product in Q1 next year. Yeah.
So we'll look forward to those launches as well. Pictet out with their first 3 ETFs in the U.S. market with, of course, more to come. Our big thanks to Liz Dillon. She is CEO of Pictet Asset Management USA. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. I have a tattoo of that, actually. But that does it for Bloomberg ETF IQ, the television show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.